Hi everyone, this is Mrs. V. Chen. Welcome to my Form 4 Accounting lesson number 15. Today is 23rd April 2020. Okay, so today's lesson is about capital expenditure and revenue expenditure, and then I'm going to use double entry to explain to you what is meaning of capital expenditure and revenue expenditure. So expenditure means we have to pay money and then we need to spend money. Okay, so therefore, if we spend money, we credit bank, for example. Okay, and then after crediting bank, so we must debit something, okay, because we always do double entry. But the point is, okay, which account we have to debit? Actually, for the debit items, there are two ways to go. All right, so let's look at the debit item. If we put the debit item in the profit and loss account, that means it is a kind of negative thing to the business because all debit item in the profit and loss account means expenses. All right. However, if we don't put this in the profit and loss account, however, we put this in the statement of financial position. So the debit item in the statement of financial position will be a positive thing because they are non-current assets. Okay, so therefore, all expenses in the profit and loss account, we call this revenue expenditure. And then we name this non-current assets, which being positive to the business as a kind of capital expenditure. Okay, so if you go to your textbook on page 158, you find the meaning of capital expenditure. And here we have the example, like acquisition of non-current assets. And acquisition here means buying the non-current assets. The money spent on buying non-current assets is called capital expenditure. And all non-current assets are durable, so therefore capital expenditure will generate long-term benefits for the business. Okay, and then we have another point for capital expenditure, which is about extension or improvement to existing non-current assets. So for example, if we spend 100,000 to buy this motor vehicle, and therefore this 100,000 must be non-current assets. So this would be the costs of the motor vehicle. However, this motor vehicle we bought, which is without any air conditioning, and this is not comfortable. And then later on, if we spend another, let's say 5,000, okay, to install air conditioning. Okay, if we spend 5,000 to install air conditioning into this motor vehicle, that means the motor vehicle, the condition, okay, after this air conditioning will be much better than before. So therefore, this 5,000 should be parts of the costs of motor vehicle. Okay, so therefore this 5,000 should be also counted as a kind of capital expenditure. So therefore, how much should be the total cost for this motor vehicle? It will be 100,000 plus another 5,000. So the total cost will be 105,000. Okay, so this is the example for this extension or improvements. The money spent on this, okay, to the existing current assets should be also a kind of capital expenditure. Okay, next, you will find on page 159 for the meaning of revenue expenditure. So the meaning is that expenses needed for day-to-day running of the business. So all expenses in the profit and loss accounts, we call that revenue expenditure. For example, office rents, wages and salary, petrol for delivery vans, right? And how often we pay that? We pay that very often, and then we pay these expenses regularly as well, because that is related to day-to-day operation of the business. Okay, but the point is why we have to identify clearly capital expenditure and revenue expenditure, because remember, when we prepare financial statements, we're not just preparing that for our own use. There are so many people, they rely on our reports to make decisions, is that right? So therefore, let me give you two different situations. The first situation, so what happens if we have revenue expenditure? however, being wrongly treated as capital expenditure. Okay, so what is meaning of revenue expenditure? These are expenses in the profit and loss account, is that right? However, not being treated as expenses, but treated as capital expenditure. That means expenses will be too small, okay, and the net profit will be too large. So that profitability will be bigger than before. Of course, this is not true, okay? Then non-current assets will be also overstated. Okay, so therefore, people may think that we have good performance and then we have larger amounts of non-current assets. Of course, this is not true at all, okay? Okay, so and then what happens if I don't correct my mistake? Then the users like shareholders or the lenders may be misled by my wrong information. Of course, this is illegal to do that and also unethical. All right, let's look at another situation. So if capital expenditure being wrongly treated as revenue expenditure, that means it should not be expenses in the income statement. However, it should be a kind of non-current assets. Then what happened to my expenses? My expenses will be bigger, right? If bigger expenses, then net profit will be smaller. So therefore, so how much taxation that I pay to the government? So, and how do we calculate taxation? Taxation is always calculated on some percentage times the net profit. Therefore, I pay less tax to the government. Of course, this is not allowed and it is also unethical and illegal to do that. So you can see it is very important. We have to distinguish clearly, okay, what items should be capital expenditure and then what items should be revenue expenditure, because we have so many people, so many users, they rely on our financial reports to make decisions. Okay, now here is the past exam question in 1996. And then what we need to do is to draw up molding machine accounts and provision for depreciation. So I just updated the name to accumulated depreciation here. So this is molding machine. All right, and then C, we need to draw up disposal account. So here is my disposal account. Okay, let's look at the question. So here we have the question. So Baka Limited, a manufacturing company, purchased a molding machine from Sakura Company of Japan, and the invoice price being 52,500. That means we are Baka Limited, and then we buy this molding machine from Japan with this invoice price, which is same as the selling price. Okay, and then the machine was received on 16th December 1992 after the purchase price. So this invoice price is same as the purchase price, plus not only that, so more things we have to pay. We need to pay import duty. So this is a kind of tax that we need to pay to the government. And then we need to pay landing charges. And then here on 1st of January, we need to pay installation. So what happens if we don't pay this import duty, landing charges, and installation? We cannot use the machine in our business. All right, so therefore, this import duty, landing charges, and installation must be treated as capital expenditure. And also, we just pay these expenses once, okay? All right, since they are capital expenditure, so all these items, so this is purchase price, import duty, landing charges, and the date for installation should be treated as capital expenditure. Okay, if they are capital expenditures, that means I have to treat this as part of the costs of molding machine, like this. Okay, and then how often we pay that? We just pay this once. Okay, and then if we don't pay them, we cannot use the molding machine in our business. Okay, so therefore, when I close the accounts in the first year, I need to go back to find the financial year end. So financial year end on 30th September. So here will be the last day, 30th of September. I close it, balance carry down. So how much will be the total costs of molding machine as a kind of non-current assets? So that will be 52 plus 5 2. So that will be 62,300 and 62,300 and 62,300. Okay, so this is the closing balance. Okay, and also the total cost for the molding machine as a kind of non-current assets. So if I move on to the closing to the next year, so that will be 62,300 to begin with, and the year will be 1993 to 1994, and the following date, 1st of October, I have this balance brought down to begin with in year 2. Okay, and then I repeat, this is 1993 and 1994, so that will be in year 2. Okay, now we have the costs of molding machine being 62,300. So what happened if we use this molding machine again and again and again? The value goes down, is that right? So each year at the end, we have to provide depreciation. So here we have some information. The company estimated that the machine would have a useful life of 10 years and a scrap value of this. So that means this is using straight line method to provide that. Okay. All right, so, and then here is the timeline. So this is in year 1. So the financial year ends on 30th of September, and then this is year 2. Okay, but the dates for the machine received on 16th of December. So here is 16th of December, we received that. Okay, but should we count depreciation starting on 16th of December? Okay, the answer is no, because we haven't installed the machine yet. So the dates to start using the molding machine for start calculating depreciation should be on 1st of January. So here is 1st of January 1993. Okay, so this is after installation. Okay, if we don't install, we cannot use the molding machine. So right after installation, now we can use the machine. So the dates starts providing depreciation should be the dates here, 1st of January. So this accumulated depreciation accounts is a real account, so therefore I have to close this 3,600 as the closing balance, and this closing balance will be the opening balance in year 2. Okay, so I start with 3,600. So I go back to my timeline. This is in year 2, and also we still have this molding machine until, if you go back to the question, the performance of the machine was not satisfactory and it was sold on this 30th April 1996, so we are still in 1994, so I don't need to bother that. So this is the second year we need to provide depreciation, and the double entry is debits, depreciation, and credits, accumulated depreciation. So we do that at the end. So this is because of depreciation. However, in year 2, 62,300 minus 14,300 times 1/10. Now this time, which is not 9 months, because we use it for the whole year in year 2. So that will be, okay, my calculator, 62 minus scrap value divided by 10. So which is what? Which is 4,800. Okay, so altogether, how much is closing? So 8,400, 8,400. So the date to close that balance carry down is 8,400. Okay, and this is closing in the year 2. In year 2 will be opening 995. So 1st of October balance brought down. Okay, in year 3. Okay, so we have done everything in 1994 this September, which is in year 2. Now we come to year 3. Okay, so since the disposal happened on 30th April 1996, so this is 1996. Okay, so that I extend my timeline here and up to 30th, so here is 30th April 1996, and then we have disposal happened in 1996, but now we still need to continue about everything in year 3. Okay, so that's here, this is in year 3. We need to provide depreciation again, okay, which is 4,800, because using straight line method each year the depreciation will be the same. Okay, so 1994, 1995, and this is 30th, the end of financial year end. So okay, so that will be 840 plus this, so altogether I have this, right? So 13,200, and this 13,200 will be the opening balance. So first of this 13,200, right? Okay, and then also in this molding machine account, so this is the first year. Okay, we'll work out the costs for molding machine, and then we have nothing happen. So this is in year 2. If we have nothing happen, we just open it and close it. So 62,300. So the last date 30th of September, balance carry down. Okay, so this closing in year, okay, I have no space. So this year 2 will be for 1995. Okay, first of this opening balance, so 62,300. Okay, nothing happens. I just open and close, open and close. 1995. So 30th of this. Okay, so this is balance carry down 62,300. Okay, so the first year, the second year, the third year. Now we come to the fourth year, so 1995, 1996. Okay, so I have first of this balance brought down 62,300. Okay, now we have extend everything up to the fourth year. Okay, so this is the fourth year. However, in the fourth year, this is year 4, right? So we still use the molding machine for this month. Therefore, before we come to disposal, we still need to provide depreciation, okay, for this period in year 4. So how many months is it that we have used the molding machine in year 4? So you have to count this very carefully, otherwise your figure would be wrong. So it should be 7 months. Okay, so here is the figure for depreciation. So we have 4,800, so which is same here. That's in year 4. We just use it for 7 months. So this is 7 months. Okay. Alright, so that would be 4,000 times 7 divided by 12. So we have 2,800 like that. Okay, so finally what happened in year 4? So here we have the machine was not satisfactory and it was sold for this much, 41,625 on April 30th. So therefore we have disposal on the dates here. And then remember, we always have 4 double entries for disposal. The first one, to delete molding machine, we credit molding machine and debit disposal and credit. And then step 2, we delete accumulated depreciation like this as before, and then we have money received for that. Okay, so after these 3 double entries, now we can come to posting here. So step number 1, okay, debit disposal because of molding machine, and the cost is 62,300 and the date 1995 in between of this, and the date is on 30th April. Why we debit disposal? Because of molding machine. Okay, we do posting. So debit disposal, credit molding machines, and this is my molding machine account. Okay, so 1995 and 1996 and 62,300. The date is 30th of April. Why we credit molding machine? Because of disposal. Okay, so therefore debit side 62,300 and credit side 62,300. You can see we don't have any molding machine left because we have this molding machine being deleted in the disposal account. So no more closing balance. Okay, and then now step number 2, we have to delete accumulated depreciation. So we debit accumulated depreciation, and how much altogether? So it has been accumulated up to this, so 16,000, 16,000, 16,000 here because of disposal. So what happened right after this? We have no more closing balance in the accumulated depreciation account. So this is how we delete accumulated depreciation and then we credit disposal. So I go to my disposal accounts. So I will have 16,000. So 995, 996. The date for disposal, April, and this is because of accumulated depreciation. Okay, step 3 for disposal is to receive money. So that debit bank and credit disposal. Therefore, here I credit disposal because of money received. Okay, so now I can close my disposal accounts. So credit side is positive because we have this money received and this is negative. And let's see which one is bigger, which one is smaller. So this is 16 plus 41,625. So this side is bigger. Okay, so I need to insert things on credit side. All right, so this is negative side is bigger. So obviously this is loss on disposal. And later on, we have to put this in the profit and loss accounts. And the difference is 6,300. So we have loss of disposal for this molding machine. Okay, so this is the disposal account to work out whether we have gain or loss. But in this question, we have loss. Okay, and then you can check in the molding machine. Okay, after disposal account, we don't have anything left. And also, after accumulated depreciation account, we don't have anything left. And also in this question, what is so important is about the treatment of capital expenditure. So they are import duty here, landing charges, installation. They are all parts of the costs of the molding machine. Also, when you calculate depreciation, timeline is very, very important. Okay. Okay, so finally, let's take a look at this timeline again. So this is year 1. So that, let's say DEP 1, we have 3,600 for depreciation. Okay, only 9 months. And then year 2, year 3, and then in year 4, only 4 months. So what happened if we add up all this depreciation in these 4 years? So how much is it? 3,600, 4,800, 4,800 plus 2,800. So what is it? It is exactly same as the depreciation, accumulated depreciation account, saying that this is the accumulated, so which is getting bigger. So therefore, when you look at the disposal account here, so how much is accumulated depreciation, which is also 16,000, which is equal to all the depreciation added up to get the total for accumulated depreciation accounts. Okay, so I think that's all for today's lesson. Thank you for watching my video. I'll see you next time. Bye bye.